So far, it is only talking, but no action from Beijing. And I guess if we actually get action, we should expect quite a substantial move in markets in a positive direction, since the Chinese sentiment is basically completely bombed out. The signals are telling me to expect deflation in China, but reflation elsewhere around the globe. Welcome to this live edition of Steno Signals. I'm Andreas Steno, founder of Steno Research and senior editor here at realvision. And we've had a tremendous week in global macro with inflation numbers out of both the US today, but also China earlier this week. And I'd like to start with a rundown of the numbers from China, because they were out of the ordinary, to say the least. And if we look at the Chinese CPI right now, it is now officially in negative territory, so in deflation territory, and we don't see that often, especially not in the West, but obviously not in China either. So is this a biggie or a nothing burger, this deflation number from China? It is now at 0.3% negative year over year. But we've actually seen early signs of a reacceleration of trends also in the Chinese consumer price index. It is not necessarily the most important inflation index out of China, at least if we look at it from a Western perspective. Instead, I typically watch the producer price index in China. It is also in deflation territory, and it is a better leading indicator of trends in the West, since China is in many ways still the factory of the world. And if we look at these Chinese PPI trends versus trends in the US consumer price index, we still have some catching down to do in Western inflation relative to the trends that we've seen in Asia. And the gap is relatively wide right now between the deflation seen in China and the inflation seen in the US, but also in Europe. And I guess the reason is that Chinese exports are not as massive as they were just 2-3 years ago. Also, this week we got the latest set of trade data out of China, and the export numbers surprised on the downside. Also, the import numbers surprised on the downside in China. So everything from China just keeps surprising to the downside. And of course, ultimately, this is something to worry about if you are in the camp of a short-term cyclical upswing, as I am, since China typically fuels such an upswing, both via lower prices, but also via a higher activity level, and that activity level remains nowhere to be seen in the Chinese economy. Maybe this will spur a reaction from the Chinese authorities. That is at least my hope right now, that the confirmation of negative price developments in China, the confirmation of negative export and import trends will convince the CCP, the authorities in China, to actually pump some money into the system, which is very, very needed at this juncture. The question is whether they will copy-paste the Western playbook from the reopening period after COVID, meaning that they basically print money and hand them out to everything from people to corporates. But it remains to be seen, and so far it is only talking, but no action from Beijing. And I guess if we actually get action, we should expect quite a substantial move in markets in a positive direction, since the Chinese sentiment is basically completely bombed out at this juncture. Also, various positioning surveys sort of reveal a similar story in China. No one's buying China at the moment, meaning that the risk reward is pretty decent if they actually move ahead and print some money. If we look at the US inflation report out a little earlier this morning, US time, we have an odd cocktail now of headline inflation, including energy, moving up on a yearly basis, and core inflation moving down on a yearly basis. And if we look at that cocktail, historically speaking, it is a very rare phenomenon. I think we have 4 major periods of headline inflation reaccelerating while core inflation decelerates. And we need to go back all the way to 2010 to find the latest observation, and then before that, we need to go back to 1981 and back to the 60s to find a couple of additional periods of such a cocktail. So it's not necessarily the most common cocktail, and I think that cocktail will actually continue at least for the next month or two, given that we see upwards pressures in commodities, oil, natural gas also this week, while we see declining price pressures in some of the stickier categories in the inflation index, and especially in some of the goods with a relatively large weight in the US price index. And if we look at the details of this inflation report, it was essentially more or less smack dab at forecast. So we haven't had a major reaction to it. The market is pretty positive today since the so-called disinflation seems to be confirmed here. Both headline inflation and core inflation printed around levels on a monthly basis consistent with the 2% target. The issue is that a couple of outliers sort of drag down the overall level of inflation, and it's not given that these outliers will sort of continue over the next couple of months. To mention a few, you can see it in the table here, the used cars and trucks down 1.3% on the month. That is a major component when the move is so significant. And then airfares are down, I think, 8.4% thereabout in today's inflation number. And I can guarantee you that airfares will not drop 8% a month over the next 2-3 months, because then we will get below 2020 levels, so below early pre-stage COVID flight ticket levels. And that is not feasible given that the economy is now fully reopened, obviously. So it is a mixed bag of goodies, if you ask me. Some of the major trends still point towards this inflation, but I think it will be tricky to get to 2% before the commodity market helps inflation reaccelerate. And that is essentially what we've seen over the past month or two here, that inflation is now again driven, at least partially, by the energy components. If we look at everything in the consumer basket in the US, aside from shelter costs, that is, of course, a hypothetical exercise, given that at least most of us have a home. And the CPI less the shelter cost is only interesting because the Fed cares about that metric. And if you look at the less shelter cost inflation, we're actually pretty close to zero inflation in the US. So the reason why inflation is now at 3.2% in the US is that shelter inflation is at 3.2%, or it makes up 3.2% of the entire basket, right? So without shelter costs, we're actually at a juncture where the Federal Reserve could easily pause. The question is just whether the shelter component, which typically lacks actual development since it takes time until everyone gets a new lease or a new rental cost, whether that shelter component will disappear in time for the rest of the basket not to pick up already ahead of it. And I'm starting to doubt that, given that we see price reacceleration in energy, and given that we see price reacceleration in several industrial commodities as well, and now also natural gas this week, and that is important as well.
Hey, sorry to interrupt again. It's Raoul here from Real Vision. I'd love for you to subscribe to the channel, get the notifications. We have so many incredible conversations with so many amazing people. It will really help you in your financial journey and your journey to understand just what the hell's going on in this world. Anyway, click subscribe, get the notifications, and enjoy.
When we look at this ex-shelter discussion in the US CPI, I have an important point to make when it comes to US inflation relative to European inflation. The US inflation methodology puts much more weight on shelter costs than the European methodology. The European so-called HICP inflation methodology leaves out so-called imputed rents, and hence rents and shelter costs are not particularly material in the European inflation basket. So now that inflation is gone in the US, if we set aside shelter costs, my base case is essentially that inflation will be gone in Europe in 6 months from now, since European inflation trends tend to lag those of the United States. And that is something that is in sharp contrast to the general atmosphere and the general consensus out there because that will essentially allow the European Central Bank to pivot ahead of the Fed, which is not what we expect. If we look at market pricing, it's not what the consensus expects, and therefore I think this is of relevance to cross-asset moves in the quarters ahead, since Europe will basically move towards lower interest rates much ahead of the US. And I think that could be relevant, first of all, for the euro versus the US dollar. If you look at the shelter component in the EU basket versus the US basket, I have a chart on sort of the weights in each of the inflation indices. And as you can see, there's a big difference, more than 30% in the US, but only 5% in Europe. So how do we trade this? What do we make of it, given what's ongoing in commodity space? I will spend the last 5-10 minutes of the show this week on elaborating on natural gas trends, because we've seen a material spike in natural gas prices over the past week. And I think it is very, very telling in relation to the tightness of the supply in this natural gas market still. The reason why we've seen a price spike is that a couple of unions announced strikes in Australia at LNG facilities, so liquid natural gas facilities, meaning that there is a potential supply cut coming up from Australia. And given that the LNG market, so the liquid natural gas market, has grown in significance over the past couple of years due to the lack of Russian gas, etc., the lack of natural gas on global seas from Australia basically means that the bidding war between Asia and Europe, and ultimately also other countries, will likely be reignited if this supply cut in Australia is prolonged. And as you can see from the benchmark index in Europe, we've also seen a price spike in the US, but not to the same extent. There is a big upwards pressure in prices right now. We've seen a small retracement after I printed this chart just a few hours ago. But the TTF benchmark in Europe was up, 40% yesterday, and it's up 55% over a short time period here. And interestingly, this is of relevance for all euro assets, if you ask me. Maybe also for dollar assets down the road, but potentially mostly for euro assets short term. The reason is that the natural gas price is the most significant contributor to trade surpluses / trade deficits in Europe. And if we look at the most recent trend with a price hike to roughly 40 euros per megawatt hour in the benchmark in Europe, we're approaching what I call the sort of break-even level for natural gas prices in Europe. If we get to 50 roughly on the TTF benchmark, the trade surplus of Europe will turn into a trade deficit again, as we saw in the autumn of 22, because of high energy prices. And when the surplus flips to a deficit, it also means that the euro will face structural headwinds instead of structural tailwinds. It's been a bit puzzling to watch the euro price action recently, given that the euro has been very resilient despite sort of recessionary vibes out of some of the big economies like Germany and France. But I think the low natural gas price relative to just last autumn is the main driver of that. And now that the price reaccelerates in natural gas, I think it is one to watch for euro assets in general. And therefore, I think it is clearly a sign to remain overweight US assets. Also, if you're a US citizen yourself. And if you look at the sensitivity to this natural gas story across foreign exchange markets, it is pretty much one-way traffic for the US dollar if the natural gas rally continues. And I think there are reasons to expect it to continue here, which is also why I'm long energy space still and long broad-based commodities. The sensitivities to the natural gas price across various FX pairs is relatively straightforward. You have the US dollar versus a bunch of peers here. And if there is an orange bar, it means that the dollar typically gains if the natural gas price gains. And only against the Russian ruble, you should expect the dollar to weaken should these trends continue in natural gas space. And let me elaborate why there is now a decent risk reward in being long natural gas. If you look at the gas supply in Europe relative to just 18, 24 months ago, we're still receiving 30 to 35% less natural gas on a daily basis because of the lack of Russian gas flows. And despite being able to sort of recover parts of those flows via LNG, we're still far from the scenario we had in natural gas ahead of the invasion of Ukraine. And we've managed without this gas flow in Europe. But as soon as we get negative supply news, for example, the story of strikes in Australian LNG facilities, you just get a price spike immediately, since the market is so tight in the European gas market. When we look at the storage facilities in Europe, there is a tendency towards storages being filled up in due time this year relative to last year. If we look at the net additions to storage in dark blue in 23, they're a bit lower than last year, but last year they had to be bought at extremely high prices. And on top of that, the price levels likely also suggest that it makes sense to buy these storages ahead of time. But the point here is that even when a storage is full in Europe, we only have 4 to 5 weeks across the continent of storage capacity, meaning that if we get a cold snap, if we get a supply constraint due to something arising in Australia, due to maybe Putin trying to once again wreak havoc with trends in natural gas markets, then the situation is still very, very vulnerable. And here I talk about global natural gas prices, because eventually it will spill over from Europe to the US to Asia if this story reaccelerates. And therefore, we've seen quite an interesting signal in our quant-based model package on natural gas. The probability of rising natural gas prices on a medium-term scale, so 12 to 24 months ahead, has now increased to 45% from just 15% a couple of weeks ago. And this is based on supply constraints. It is based on temperature forecasts for this winter. They could be colder than average due to El Nino. And it is based on the business demand for natural gas actually picking up in Germany, France, and elsewhere now, because the sentiment was so bombed out that it couldn't get any worse. And if we look at the very short-term model for natural gas prices, based on short-term forecasts for temperatures, short-term in and outflows from storages, and the curve of the natural gas curve, we're now at roughly 80% probability of rising natural gas prices short term. So I'm relatively happy to see this, given that I've been long energy for the past 3 weeks, and it has been the exact right move to make in the equity space. And I expect it to continue given these trends that we see across the natural gas space. So finally, a portfolio update. A mixed bag of goodies, I'd say, over the past week in our live portfolio with actual money backing it. But the rotation to energy, the rotation to materials, the rotation towards the steeper yield curve that we discussed in length last week in Steno Signals has helped the portfolio perform despite quite a tricky week out there. So I'm very happy with this rotation from tech to boomer stuff, if you like, in energy space, and we keep banging the drum on that trend over the coming 4 to 5 weeks. Those were the words from me in relation to questions. We had a question on the situation in China and whether a lack of Chinese momentum could spill over to the West. And I think the key here is now to watch whether the Chinese authorities actually move ahead instead of just talking. The most recent release of communication from the administration in China basically revealed that they are no longer actively trying to sort of chase down speculators in real estate. They're no longer actively seeking a weaker currency. So they expect some kind of stabilization. And I would argue that those are the sort of the first moves towards actually doing something about the issue. So that is the thing I watch now from China. And if we actually get a stimulus package from China, then you want to be long energy and you want to be long commodities. And right now, commodities are performing despite no fiscal stimulus from China. So if you add fiscal stimulus from China to the mix, then I suppose that the trend will just be emphasized. I will leave it at that for this week. If you have further questions, then leave them in the chat or commentary section after seeing this, and I'll make sure to respond to all of the questions on a weekly basis on the platform. Remember that this is a window into my thinking on macro and on my macro portfolio. I cannot guarantee that you have the same risk appetite or risk horizon as I have. But what I can guarantee is that we will be back again next week.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.